Hi there. In this video, we explain how UK businesses can manage mixed CIS and PAYE workforces correctly during the 2026-27 tax year.
Imagine a standard project site where the main contractor remits £100,000 to an umbrella company to cover temporary labor. A week later, that umbrella company vanishes, taking your funds and skipping out on their tax obligations to the government. In previous years, HM Revenue and Customs would dedicate their enforcement resources to chasing down the directors of that missing umbrella company to recover the stolen payroll tax. This flowchart illustrates the 2026 reality. HMRC bypasses the missing intermediary entirely, issuing the massive tax bill directly to you. Tax liability no longer flows down the supply chain. It flows straight up to the entity with the deepest pockets. Operating under the assumption that outsourcing payroll insulates you from tax risk is a mathematical trap. Believing you can subcontract your liability is now the fastest way to bankrupt a construction firm. Welcome to this technical briefing prepared by the tax advisors at Fairview Accounting Services. This presentation is engineered specifically for UK main contractors, developers, and recruitment agency directors who manage a mixed workforce of PAYE employees, CIS subcontractors, personal service companies, and umbrella workers. Subcontractors will certainly feel the administrative pinch of the new legislation. However, it is the main contractor who holds the ultimate financial risk when things go wrong. We will deconstruct the three pillars of the new compliance landscape: the constructive knowledge standard under CIS, the strict regime of joint liability, and the IR35 transition trap. Surviving the 2026-27 tax year requires abandoning outdated professional intuition. You must adopt a forensic approach to supply chain management. HMRC now possesses the authority to immediately cancel a firm's gross payment status without the traditional 90-day notice period if supply chain fraud is suspected. This rapid response capability stems from Sections 62A and 62B of the Finance Act 2025-26, which established the new constructive knowledge standard. The legislation penalizes contractors who knew or should have known about tax evasion in their supply chain. In practice, this means HMRC evaluates whether you ignored obvious red flags, like missing corporate registrations or subcontractors offering pricing that is suspiciously below market rates. If you ignored warning signs, you face a direct 20% clawback of the payment to the non-compliant subcontractor. Next, HMRC disallows your previously claimed CIS credits, taxing you twice. Finally, deliberate failures trigger a 30% penalty against your remaining revenue. The crucial escalation point lies in corporate governance. HMRC can transfer this 30% penalty away from the corporate body, attaching it directly to the company director's personal finances. Turning a blind eye to a subcontractor's shady pricing is a direct, quantifiable threat to your personal assets. The government has closed administrative gaps in the construction industry scheme by reinstating the mandatory CIS nil return. You must file a report by the 19th of the month, even if zero payments were made to subcontractors. This chart maps the escalating penalties for failing to file a nil return. Missing the deadline triggers a £100 fine on day 1. It reaches £200 at 2 months and caps at £300 or 5% of deductions at 6 months. There is one notable exemption to the reporting rules. Under Regulation 24ZA, payments made to local authorities and public bodies are completely out of CIS scope. You do not verify them or include them on your monthly returns. In 2026, administrative silence is treated as non-compliance. Failing to report zero activity triggers compounding fines. That rigorous compliance standard extends directly into how you manage temporary labor, specifically through the new joint and several liability rules for umbrella companies. If an umbrella company fails to remit PAYE or national insurance, HMRC bypasses them and targets the agency directly above them. If there's no UK-based agency, liability attaches straight to you, the end-user client. Unlike the CIS rules, there is no reasonable care defense written into the umbrella joint liability regime. Under this strict liability mechanism, contractors are billed for the missing tax, even if they conducted basic due diligence checks on the umbrella provider. You must continuously audit any preferred supplier list. Vetting an umbrella company once at the onboarding stage is insufficient protection. Under these rules, an umbrella company's payroll failure is legally and financially indistinguishable from your own internal payroll failure. The compliance landscape is further complicated by the off-payroll working rules. The statutory thresholds defining a small company for IR35 exemption have increased. The turnover limit is now £15 million, and the balance sheet limit is £7.5 million. However, there is a retrospective accounting trap. A company's size for IR35 is assessed using the prior financial year's accounts, not current data. This timeline illustrates the delay. For the entire 2026-2027 tax year, you must assess your size using your 2024-2025 accounts against the old thresholds. The relief of the higher limits does not practically take effect until the following year. If a contractor or agency formally requests written confirmation of your company size, you have exactly 45 days to respond. Missing this 45-day window results in your firm being legally treated as a medium or large company, transferring all determination responsibilities back to you. Prematurely acting as an exempt small company before the transition period clears will trigger full off-payroll liability for an entire tax year. Calculating exact payment figures requires navigating the interplay between the VAT domestic reverse charge and CIS withholdings on mixed invoices. Consider a scenario where a VAT-registered subcontractor completes a £1,200 supply and fix contract, and they incur £200 in direct material costs. Take the gross invoice of £1,200, subtract reverse-charged VAT and the £200 cost of materials, leaving a taxable deduction base of £800. Calculate the 20% CIS withholding, routing £160 to HMRC. The net payout is the remaining £840, plus material reimbursement. This sits alongside overarching 2026-27 payroll costs, where employer Class 1 national insurance contributions hold at 15%. If the split is calculated incorrectly, the main contractor pays the tax difference. The overarching lesson of the 2026-27 updates is clear. Point-in-time checks at the onboarding stage are officially dead. Operating a mixed workforce demands continuous, active auditing of the entire supply chain. You must establish a strictly vetted preferred supplier list for umbrella companies, automate your CIS verification before every payment run, and accurately assess your 2024-25 accounts for IR35 transition planning. Ignorance of a subcontractor's tax affairs is no longer a viable defense. It is a direct threat to your gross payment status and your balance sheet. To protect your firm, contact Fairview Accounting Services today for a custom workforce consultation. The information provided in this video is general guidance only and does not constitute formal tax, legal, or financial advice. Tax rules, thresholds, and HMRC enforcement policies change frequently. Viewers should always obtain professional advice from a qualified accountant before making financial decisions. In a landscape where tax liability flows upward, proactive compliance is the only remaining firewall.